Look, HPG is no longer just your average cyclical steel stock. The real question we need to ask is the market fundamentally undervaluing Vietnam's emerging industrial conglomerate? Welcome to this explainer, where we're going to deconstruct Hoa Phat Group, or HPG, an absolute cornerstone of the VN30. Today, we're breaking down its rapid evolution from a traditional materials producer into a massive, vertically integrated Vietnamese Chaebol.
Now, you might be wondering, why should a global investor even care about HPG right now? Well, the important question here isn't just whether global steel prices are going to recover. It's whether Hoa Phat can turn its core cash flow into the financial engine of a totally new industrial empire, one that's deeply tied to the VN30 and foreign capital flows. For global investors eyeing the Vietnam growth story, the big ASEAN manufacturing relocation, and the upcoming FTSE market upgrade, HPG is literally the bellwether. It is the ultimate proxy for Vietnam's industrialization.
So here is our roadmap for today. We'll cover the Vietnam growth engine, the Vietnamese Chaebol era, the cash flow challenge, catalyst for re-rating, stress testing the risks, and finally, core investment intelligence. By the end of this analysis, your perception of HPG is going to completely shift.
All right, let's jump straight into Section 1, the Vietnam growth engine and its macro context.
Right now, Vietnam is undergoing this massive infrastructure push, with billions being poured into highways, airports, and huge urban developments. Yet, strangely enough, most investors are still viewing HPG through this outdated paradigm of it just being a cyclical construction steel company. They are completely missing its evolution into an integrated ecosystem supporting the ASEAN manufacturing relocation. The old model was, highly vulnerable to global commodity swings, but the new model? This Chaebol model uses the massive cash flow from steel to fund a vast ecosystem. They're integrating downstream into real estate, agriculture, home appliances, and industrial parks. They aren't just supplying the materials for Vietnam's growth, they are literally building it and owning the resulting assets.
Moving on to Section 2, the Vietnamese Chaebol era, and how they are building a vertically integrated empire.
Holding 36% of the domestic construction steel market is definitely impressive, but dominating 60% of the domestic hot-rolled coil, or HRC market, that is absolutely transformative. By controlling this high-margin space and maintaining absolute cost advantages through things like deep-water ports and being 90% self-sufficient in energy, HPG essentially controls the foundational material for almost all other industrial manufacturing in the region. This vertical integration is what gives them an almost impenetrable moat.
Now, I want you to look at how that steel dominance translates into actual urban development. $27 billion. This immense scale allows HGP to partner in mega projects, like the $27 billion Red River Landscape Access. In a classic Chaebol maneuver, they're exchanging their infrastructure and steel capacity for over 5,000 hectares of prime real estate. Think about that. They provide the materials and capital to build the infrastructure, and in return, they secure a massive land bank that guarantees their transition into a premier real estate developer for the next decade.
And this infrastructure play ties perfectly into their next technological leap. Strategically, the Dung Quest 2 ramp-up coincides exactly with the rollout of Vietnam's high-speed railway. HPG has partnered with top-tier European tech firms like SMS Group to produce specialized high-speed rail steel that can actually support trains traveling 350 kilometers per hour. By early 2027, they're going to be the sole domestic supplier of this highly specialized, high-margin product. They are basically creating a monopoly right as government procurement for the national railway kicks off.
Let's move to Section 3, the cash flow challenge. We need to break down the capex, debt, and margins.
You see, most investors just stare at steel prices, but they completely overlook the true cash flow quality backing up these massive expansions. Obviously, funding an empire like this requires an unbelievable amount of capital. And yes, it is true, HPG is carrying what looks like a very intimidating 90.6 trillion VND in debt to fund Dung Quest 2. When a mega project like this completes and transitions from an asset under construction into a fixed asset, capitalization of interest actually stops. That means those borrowing costs, which are roughly 1,300 billion VND in a single quarter, hit the income statement directly. This is exactly the number that makes retail investors super nervous.
But wait, there is a flip side here. They also hold 43.5 trillion VND in strategically priced inventory,
And guys, this acts as a massive buffer. Because they were smart and procured raw materials like coking coal and iron ore when prices dipped, and because finished steel prices are stabilizing, the spread between raw materials and finished goods is actually widening. This inventory is essentially a coiled spring of low-cost capital just waiting to be converted into high-margin revenue.
So the really crucial point is how all of this converts to cash. What we're looking at is a violent free cash flow inflection point, with operating cash flow projected to surge to 17.2 trillion VND in Q1 2026. This proves their core business can easily digest that heavy debt burden. The market is busy watching the HRC expansion while completely ignoring the incredibly strong balance sheet behind that expansion. They've got over 35 trillion VND in cash and deposits, providing a massive liquidity cushion. The era of heavy capital expenditure is winding down, and the era of cash harvesting has officially begun.
All right, Section 4, Catalysts for Re-rating. How does HPG break its valuation ceiling?
With the balance sheet stabilized, we have to look at the immediate growth drivers that will practically force the market to reprice this asset. It's really a perfect trifecta for growth: government protection against cheap Chinese imports, massive public investment, and the huge margin expansion from Duncourt 2. That 27.83% anti-dumping tax on Chinese HRC, that is a total game changer. It effectively shields HPG's domestic market share and ensures their profit margins stay heavily protected, right as Duncourt 2 hits maximum output.
Trading at a forward PE of just 9 to 10 times, HPG is significantly undervalued compared to regional heavyweights like POSCO or JSW Steel. That sets our base case target right at 35,000 to 36,000 VND. The market right now is still pricing HPG as a legacy construction steel company, but once institutional capital fully digests the sheer cash flow generation coming from HRC and the real estate optionality, a multiple expansion is highly probable.
But we can't just look at the upside. Section 5, stress testing the risks. What could go wrong? We must remain completely objective here and look closely at the downside. There are 3 specific risks we have to monitor: the persistent threat of Chinese overcapacity, exchange rate fluctuations on their dollar-denominated debt, and the upcoming European carbon border taxes. If China finds a loophole around those anti-dumping tariffs, it could definitely compress margins. Plus, because they use significant US dollar debt to import European machinery, a strong dollar directly eats into their bottom line. Lastly, as the EU enforces stricter green steel mandates, HPG is going to have to invest heavily in carbon reduction tech just to maintain its export viability. Finally, Section 6, Core Investment Intelligence. Here is your executive summary.
To distill this entire massive ecosystem down to the absolute essentials for your portfolio, you just need these 5 hero numbers. These figures define the modern scale of Huafat, cementing its status in the top 30 steel producers globally. The 15 to 16 million tons of capacity gives them the scale to compete on a global stage. The massive inventory gives them serious pricing power. And that operating cash flow, that proves the model works, easily servicing their debt while securing unprecedented urban development projects.
Moving forward, if you want to accurately gauge the health of HPG's cash engine, strip out the one-off real estate profits and track these 5 core metrics. It's absolutely vital to separate their core steel operations from abnormal, one-time asset sales, so you can truly understand their operating leverage. And definitely keep a close eye on foreign capital flows as Vietnam marches toward an emerging market upgrade. Simply put, HPG is way too large for foreign institutions to ignore.
Because at the end of the day, HPG's real attraction is not only steel prices, it's whether they can fund an industrial ecosystem. They are actively turning the cash flow of their core business into the financial engine of a massive Vietnamese industrial footprint. And remember, big money does not move before the news, it moves before expectations. By the time the broader market fully prices in Duncourt 2 and these new real estate ventures, the fundamental re-rating will have already happened.
If you found these insights valuable, make sure to subscribe to LIEMT Core Investing, where we transform complex financial topics into clear, actionable investment intelligence. We provide the structured analysis you need to understand emerging market powerhouses.
Thanks so much for joining us for this explainer. I'm going to leave you with this final thought. Is the market chronically undervaluing HPG as a mere steel stock, or are we witnessing the birth of Vietnam's most powerful industrial chaebol? Let us know your thoughts. Keep an eye on those cash flows, and we will see you next time.